So loads of people approach me when they're in their 40s, maybe mid 40s, and it seems to be a point in time where they feel like they've just arrived. Actually, loads of people have said they've just woken up at maybe 45 years of age and don't realise how they've got there. They actually say that in their 30s as well, when they're probably at the getting kids for the first time. I suppose in the 40s is when they really have assets. So people in the 30s kind of stumble into their 30s and might have still a little bit of debt, or they might still have a little bit of, I suppose kids are young, creche fees, big enough mortgage. By the time they get to 45, that's usually sorted itself out. Kids are in school, if not reared already. And they now have this situation where they're thinking about the home run, they're thinking about 60 years of age, they're questioning when are they going to retire, what's it going to look like, what it's going to feel like, do they have enough assets? The biggest question I get is, Paul, I have a lump sum of money. Some is inherited, some is saved. Should we, or unfortunately some people take redundancy, and some people want to take redundancy in fairness in some cases, but they have a lump sum of money and they're asking me, do we pay it off the mortgage or what do we do with it? It really is a case-by-case basis, and the full financial planning consultation we use cash flow modelling, so we can show people what that looks like, and we can give them all the scenario, so we can show them it looks like clearing some of the mortgage, all the mortgage. But I generally don't think they should clear the mortgage in most cases. Now, like I said, every case is different, but in most cases I think it's a really good opportunity for somebody to, if they had the risk tolerance to do this, to maybe get a second property, go into getting an investment property. They could clear down the small mortgage on the investment property before they get to 60 maybe, and that means they've got a second income coming in and not only relying on their retirement income. What people really need to realise, I suppose, this age group is that if you are lucky enough to have a company pension plan or even a personal pension plan, that when you get to retirement age at 60 or 65 years of age, you need more than the pension. So you don't want to be just relying on your pension. You want to have a second income or a big investment account. But as I said, majority of the time I'll say to people not to clear their mortgage. And the main reason for that is that mortgage interest rates are ridiculously low at the moment. You know, they're hanging in around 2%. We've got new lenders entering the market going below 2%. That's not free money, but it's the cheapest interest rates I've ever been in this country. So I think you should take advantage of that. I think you should either buy a second property, whether you need a mortgage or not, depends on your lump sum, or else you should consider investing that money and having a much bigger lump sum behind you by the time you get to 60 years of age. The only instances I've ever said for someone to clear their mortgage really is if they really are passionate. Some people are born or bred this way or brought up this way, and that they want to be mortgage free because their mum and dad were by 50, and it's a real personal achievement for themselves. And if that is their personal achievement, no matter what the figures look like, they should be going with whatever their own personal good is or their feeling is. But yeah, technically speaking, if you arrive mid-40s, you have a lump sum, you know, I would be saying keep it, invest it, and maybe look at property or an investment account. The next thing that people say around this age is that they have a lot of cash built up because they've got really big incomes. And when I say by really big incomes, you find that couples are probably north of the 150 grand combined. That puts them in a very, like, the top earners in the country if they're earning that type of money. Usually brings in around 100 grand net income, so after tax a year, which is like a phenomenal amount of money. And again, if your kids are rare, you kind of have this, maybe you haven't got the lump sum like the other people spoke about, but you might have maybe an extra 3,000-4,000 on a monthly basis, which is a lot of money. And again, invested, you know, it can just make such an impact on those last 10, 15 or 20 years before you get to retirement age. But we show everybody this on the cash flow model, which is the good thing, and we get them to decide what they want to do. It might be a mix of paying off the mortgage a little bit or paying it down a little bit and investing. But I just think you need to keep the cash in the bank for yourself or an investment account, because you need to be your own bank. You don't want to be paying back the bank too early and then find that 55 you're borrowing for a car for the money you just kept to the bank 10 years ago. It doesn't make any sense at all. Big thing I'd encourage everyone to do, I know I probably need to say this, or it seems like I need to say this, but it's just get the full financial planning consultation, because we'll be able to put the figures in and give you all the options of what life looks like with all these big decisions you have to make at this stage of life. Because whatever decisions you make now in your 40s, mid-40s, will definitely have a massive impact on your retirement and the type of life you're going to have in retirement. So it's really important to get advice.